Something extraordinary is happening in the silver market right now, and most investors have no idea it's coming. While everyone's been watching gold hit new records, silver has been quietly setting up for what could be the most explosive move in precious metals history. And I'm not talking about a modest 20 or 30% gain. I'm talking about a potential move that could dwarf everything we've seen in the past 4 decades. Let me show you what's really happening behind the scenes, because the data I'm about to share with you tells a story that Wall Street doesn't want you to hear. Right now, silver is trading around levels that would have seemed impossible just a couple years ago. But here's what's fascinating. Despite these elevated prices, we're seeing something that defies all conventional market logic. Industrial demand isn't slowing down, it's accelerating. And that's creating a perfect storm that could send prices into territory that most analysts won't even dare to predict publicly. Think about this for a moment. When was the last time you saw a commodity in a supply deficit for 5 consecutive years? Not 1 year, not 2. 5 straight years where global demand has exceeded supply. And those deficits aren't small. We're talking about hundreds of millions of ounces that simply don't exist to meet current demand. The cumulative deficit over this period has reached over 800 million ounces. That's not a rounding error. That's a structural crisis. Now, you might be thinking, well, if there's a deficit, why hasn't the price already exploded? And that's exactly the right question to ask, because the answer reveals something crucial about how this market actually works, and why the explosion, when it comes, is going to be so much more violent than most people expect. You see, silver has this unique characteristic that makes it different from almost any other asset. It's simultaneously a precious metal and an industrial commodity. Gold is primarily a monetary metal, a store of value. Copper is purely industrial. But silver sits right in the middle, and that dual nature is creating dynamics we've never seen before in market history. Let me paint you a picture of what's happening in the industrial sector right now. Solar panel manufacturers used to use about 20 milligrams of silver per cell. That was the standard for years. But as efficiency demands increased and new technologies emerged, that number started climbing. Today, some of the latest high-efficiency panels are using 30, 40, even 50% more silver per panel than they did just a few years ago. And here's the kicker. Solar installations aren't slowing down. They're accelerating at a pace that's shocking even industry insiders. In one recent year, solar panel usage alone drove silver demand up by more than 25%. 25% in a single year for just one application. Now multiply that across the entire green energy transition that's happening globally, and you start to see the magnitude of what we're dealing with. But solar is just the beginning. Let's talk about electric vehicles for a moment, because this is where things get really interesting. A traditional gasoline-powered car uses somewhere between 15 to 28 grams of silver, not a huge amount. But an electric vehicle, an EV, uses anywhere from 25 to 50 grams of silver, and some high-end models use even more. That's roughly double to triple the silver content of a conventional vehicle. Now, here's where the math gets scary for anyone betting against silver. Global automotive manufacturers have committed to producing tens of millions of electric vehicles over the next several years. We're not talking about a niche market anymore. We're talking about a fundamental transformation of the entire global automotive industry, and every single one of those vehicles needs silver. Not wants it, needs it. Because there's no viable substitute for silver's unique combination of electrical conductivity, thermal conductivity, and reliability in the applications where it's used. I want you to imagine something for a second. Imagine you're running a solar panel manufacturing facility. Your production line is humming along, you've got orders backed up for months, and suddenly your silver supplier calls and says, "We can't get you the quantity you need." What do? You can't just stop production. You've got contracts, commitments, deadlines. So what happens? You pay whatever it takes to secure the silver you need. And that's not a hypothetical scenario. That's what's starting to happen right now in industrial markets around the world. But here's where this story takes an even more interesting turn. While industrial demand is surging, something else is happening on the supply side that most people aren't paying attention to. Silver mining isn't like flipping a switch. You can't just decide to produce more silver because the price went up. Most silver, about 70% of it, comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is largely dependent on the economics and production levels of these other metals. What happens when copper mines slow down because copper prices are weak? silver production drops, even if silver prices are strong. What happens when environmental regulations make it harder to open new mines? Silver supply gets constrained regardless of demand. What happens when existing mines deplete their reserves? It takes years, sometimes a decade or more, to bring new production online. And here's the reality that's keeping mining executives up at night. There aren't enough new silver projects in the pipeline to replace depleting reserves, let alone meet growing demand. The lead time from discovery to production for a major silver mine can be 7 to 10 years. Think about that. Even if companies started aggressive exploration programs today, we wouldn't see meaningful new supply until well into the next decade. Meanwhile, above-ground inventories, the silver that's sitting in warehouses and vaults around the world, have been steadily declining. These aren't just numbers on a spreadsheet. These are physical ounces that industrial users, investors, and mints are drawing down month after month. And unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed. It gets used up in industrial applications where it's not economically viable to recover it. Once it's gone, it's gone. Let me tell you a story that illustrates just how tight this market is becoming. There's a major exchange where silver futures are traded, and recently something unusual happened. The amount of silver standing for delivery, meaning people who actually wanted to take physical possession rather than just settle in cash, started increasing dramatically. Now, in a normal, healthy market, that shouldn't be a problem. But when you've got a market that's been in deficit for 5 straight years and inventories are declining, suddenly those delivery demands start to matter. What happened next was fascinating. The premium for physical silver over the paper price started widening. In some markets, you couldn't buy physical silver at anywhere near the quoted futures price. You had to pay significantly more. That's not supposed to happen in an efficient market. But it's exactly what you'd expect to see in a market where the paper claims on silver far exceed the physical metal available to deliver. Now, I want to shift gears for just a moment, because if you're sitting on a significant retirement account, maybe $100,000 or more, there's something you should know about. I've put together a comprehensive guide on how gold IRAs work, and it's available in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. And given what's happening in these markets, it's worth understanding your options. But let me get back to why this silver situation is so critical right now. Here's what makes this moment in history so unique. We've never had a situation where industrial demand for a precious metal was growing this fast while supply was this constrained. Never. And we've certainly never had it happen while central banks around the world are printing money at unprecedented rates and governments are running deficits that would have been unthinkable just a generation ago. Think about the implications of that for a second. You've got a metal that's essential for the green energy transition, for electric vehicles, for 5G infrastructure, for medical applications, for water purification, for countless industrial processes. And at the same time, you've got investors looking at that same metal as a hedge against inflation, against currency debasement, against the kind of monetary chaos that seems to be becoming the new normal. What happens when those two sources of demand collide in a market that's already in deficit? What happens when industrial users who absolutely need silver to keep their production lines running start competing with investors who want to protect their wealth? What happens when that competition plays out in a market where there simply isn't enough physical metal to satisfy everyone? Let me give you a historical parallel that might help put this in perspective. Back in the late 1970s, silver went from around $5 an ounce to $50 an ounce in a matter of months. Now, that move was driven primarily by speculation and market manipulation by a few wealthy individuals. But imagine what could happen in today's environment, where the fundamentals are actually supporting a massive price increase, where the supply deficit is real, where industrial demand is structural and growing, where monetary conditions are far more extreme than they were in the 1970s. Some analysts are starting to whisper about silver potentially reaching triple digits, $100 an ounce or more. And while that might sound crazy to people who remember when silver was trading at $15 or $20, when you actually look at the supply and demand fundamentals, when you look at the historical gold-to-silver ratio, when you look at the amount of money that's been created in the financial system, suddenly those numbers don't seem quite so outlandish. Here's something else that's not getting enough attention: the gold-to-silver ratio. Historically, this ratio has averaged somewhere around 60 to 1, meaning it took 60 ounces of silver to buy 1 ounce of gold. But in recent years, that ratio has been all over the map, sometimes reaching 80 or even 90 to 1. Right now, even after silver's recent gains, the ratio is still elevated compared to historical norms. What does that mean? It means that if silver were to revert to its historical relationship with gold, and gold stays anywhere near current levels, silver would have to move significantly higher just to normalize that ratio. And if gold continues to climb, which many analysts expect given the global monetary situation, silver would have to move even more dramatically to maintain that historical relationship. But here's where it gets really interesting. Silver doesn't just track gold. It tends to outperform gold in bull markets. When precious metals are in a strong uptrend, silver typically moves faster and further than gold on a percentage basis. It's more volatile, more explosive, more responsive to momentum, and right now we're seeing the early signs of exactly that kind of move beginning to develop. Let me walk you through what's happening in the derivatives market because this is where you can see the real pressure building. There are massive short positions in silver futures, positions held by commercial traders and banks who are essentially betting that silver prices will fall, or at least stay contained. But here's the problem with those short positions. They're not backed by physical metal. They're paper contracts. And if silver prices start to move sharply higher, those short sellers are going to face a choice: either deliver physical metal they don't have or buy back their positions at a loss to close them out. What happens when a large number of short sellers all try to buy back their positions at the same time? Prices explode. It's called a short squeeze, and in a market as relatively small as silver, a short squeeze can send prices vertical in a matter of days or even hours. We've seen glimpses of this dynamic in the past, but never with the underlying fundamentals as strong as they are right now. And here's something that should concern anyone who's short silver or anyone who thinks this market is going to stay calm. The amount of silver available for delivery on major exchanges has been declining steadily. The registered inventory, the silver that's actually available to be delivered against futures contracts, is at levels that are alarmingly low relative to the open interest in those contracts. It's like a game of musical chairs where there are 100 people playing but only 10 chairs. Eventually the music stops and things get chaotic very quickly. Now, let's talk about what's happening in the physical market, because this is where you can really see the stress in the system. Premiums on physical silver coins and bars have been elevated for months. Delivery times from major mints and dealers have been extended. In some cases, popular products are simply unavailable at any price. That's not normal. That's not what you see in a market with abundant supply and weak demand. That's what you see in a market where physical demand is overwhelming available supply. And it's not just retail investors buying coins and bars. We're seeing significant accumulation by sophisticated investors, by family offices, by institutions that understand what's coming. These aren't people who are buying silver because they saw a YouTube video or read a Reddit post. These are people with access to the best research, the best analysts, the best information available. And they're buying physical silver in size. Here's a question worth considering. Why would smart money be accumulating a physical asset that's bulky, that has storage costs, that doesn't pay interest or dividends? The only reason that makes sense is if they believe the upside potential is so significant that it justifies those costs and inconveniences. And based on the accumulation we're seeing, they clearly believe that potential is enormous. Let me share another piece of this puzzle that most people aren't connecting. Central banks around the world have been buying gold at record levels. But here's what's interesting. While they're buying gold for their reserves, their countries are simultaneously pushing aggressive green energy policies that require massive amounts of silver. So you've got governments essentially competing with their own industrial sectors for precious metals. And unlike private companies, governments don't really care about price. They care about securing supply. When a government needs something for strategic purposes, price becomes secondary to availability. Think about what that means for the silver market. You've got industrial users who need silver to meet production targets. You've got investors who want silver as a wealth preservation tool. And now you've got governments who need silver for strategic initiatives, all competing for a supply that's already in deficit, all competing in a market where new supply takes years to develop, all competing at a time when above-ground inventories are declining. This is the kind of setup that creates legendary bull markets. This is the kind of situation where prices don't just go up, they explode. Because once the market realizes that there isn't enough silver to meet all this demand, once the scramble for physical metal really begins, prices are going to have to rise to a level that destroys enough demand to bring the market back into balance. And given how essential silver is for so many applications, given how difficult it is to substitute, that price level could be shockingly high. Now, I want to address something that skeptics often bring up. They say, well, if silver is so valuable, why hasn't it already gone up more? Why are we still waiting for this explosion? And it's a fair question. The answer has to do with how markets work, particularly commodity markets, and how long it takes for fundamental imbalances to translate into price action. Markets can stay irrational longer than you might expect. Prices can be suppressed through derivatives trading, through central bank intervention, through various market mechanisms that disconnect paper prices from physical reality. But eventually, always, fundamentals win. Eventually, the physical market asserts itself. Eventually, the laws of supply and demand cannot be denied. And when that moment comes, when the paper market breaks and physical reality takes over, the price adjustment is typically swift and violent. We're seeing signs that we're approaching that inflection point. The divergence between paper prices and physical premiums is widening. The stress in the delivery system is increasing. The supply deficit is persisting despite higher prices. These are all warning signs that the current price structure is unsustainable, that something has to give. And here's what makes this moment particularly dangerous for anyone who's not positioned correctly. When these kinds of moves happen, they happen fast. You don't get weeks or months to make a decision. You get days, maybe hours. By the time it's obvious to everyone that silver is exploding, by the time it's on the front page of every financial publication, the easy money has already been made. The people who profit the most from these moves are the ones who position themselves before it's obvious, who understand the fundamentals before the crowd does. Let me paint you a picture of what the next few years could look like if this thesis plays out. Imagine silver breaking through resistance levels that have held for years. Imagine industrial users panicking as they realize they can't secure the supply they need at current prices. Imagine investors piling in as they see the momentum building. Imagine short sellers scrambling to cover positions that are suddenly deeply underwater. Imagine the media finally catching on and broadcasting the story to millions of people who've never thought about silver before. That's not a fantasy scenario. That's what happens in commodity bull markets when fundamentals align with technical breakouts and investor psychology. We've seen it in oil, in copper, in agricultural commodities, and we're about to see it in silver, potentially on a scale that dwarfs anything we've witnessed before. Here's something else to consider. Silver is a relatively small market compared to other commodities and certainly compared to financial assets like stocks and bonds. The entire above-ground supply of silver, if you valued it at current prices, is a tiny fraction of the global bond market, or the stock market, or even the real estate market. What happens if just a small percentage of the money in those massive markets decides to flow into silver? What happens if pension funds, sovereign wealth funds, or institutional investors decide they need exposure to this story? The answer is that prices would have to rise dramatically just to accommodate that capital inflow. There simply isn't enough silver available at current prices to absorb significant institutional buying. And unlike stocks, where companies can issue more shares, or bonds, where governments can print more debt, you can't just create more silver. It has to be mined, refined, and brought to market. And that process takes time. This is why some of the most sophisticated investors in the world are starting to pay attention to silver in a way they haven't in decades. They understand that we're at a unique moment in history where multiple powerful trends are converging on a single asset. The green energy transition, the electric vehicle revolution, the 5G build-out, the monetary inflation, the geopolitical tensions, the supply constraints. All of these factors are pointing in the same direction. All of them are supportive of significantly higher silver prices. And here's the thing about these kinds of setups. They don't come around often. Maybe once or twice in a generation, you get a situation where the fundamentals are this compelling, where the supply and demand imbalance is this severe, where the potential upside is this significant. And when these opportunities do come around, the people who recognize them early and position themselves accordingly are the ones who build generational wealth. Now, I'm not saying silver is going to go up in a straight line. Markets never do. There will be pullbacks, corrections, periods of consolidation. There will be times when it feels like nothing is happening, when the skeptics seem to be right, when you question whether the thesis is still valid. But if the fundamentals I've laid out are correct, and I believe they are, those pullbacks are going to be buying opportunities, not reasons to abandon the position. The key is understanding the difference between a temporary price correction and a fundamental change in the thesis. As long as the supply deficit persists, as long as industrial demand continues to grow, as long as monetary conditions remain supportive, the long-term trajectory for silver is higher, much higher. And the investors who can maintain that long-term perspective, who can look past the short-term noise and focus on the underlying fundamentals, are the ones who are going to profit the most from this move. Let me leave you with this final thought. We're living through a period of extraordinary change. The global economy is being transformed by technology, by energy transitions, by monetary policy, by geopolitical realignments, and silver sits right at the intersection of all these trends. It's the metal that makes the green energy transition possible. It's the metal that's essential for the technologies of the future. And it's the metal that investors turn to when they lose faith in paper currencies and financial assets. That combination, that unique position at the crossroads of industrial necessity and monetary uncertainty, is what makes silver so compelling right now. It's not just a bet on higher commodity prices. It's not just a hedge against inflation. It's a recognition that we're entering a new era where physical assets, particularly those that are essential for the technologies and infrastructure of the future, are going to become increasingly valuable. The explosion in silver prices that's coming isn't going to be driven by speculation or manipulation. It's going to be driven by the simple, undeniable reality that there isn't enough silver to meet the demands being placed on it. And when markets confront that reality, when the scramble for physical metal begins in earnest, the price adjustment is going to be historic. The only question is whether you'll be positioned to benefit from it when it happens.